Hello everyone. Welcome to Question Hour 17, our live Q&A session with Mr. Sunil Subramaniam, MD of Sundaram Mutual, on the economy, stock markets and investments. Thank you for joining us, sir. We've already received several questions for you to answer, so shall we get started?
Yes, Shweta. Good morning, everybody. You can start with the questions that you've already received.
Our first question, sir, is where do you see the markets going in the near term?
Near term, they're going to be range bound with a lot of volatility, and I don't see them get a clear direction until the recent news around the Omicron variant gets clarity, and based on which the advanced countries' growth recovery prospects get delineated. I think market will get a fresh sense of direction only after the dust has settled on this.
The next one, sir. The stock markets were very much affected during the first wave, but not so much during the second wave. What about the future considering this current variant and, mutual funds?
So you're right that the first wave markets reacted a bit because of the uncertainty. Second wave, because they knew that we had countered the first wave well through a lockdown vaccination process. The third wave, it's hard to say, but if the medical results show that the existing vaccines are effective against the new variant, then I don't expect the markets to react too much. However, if it's not that case, then until a new discovery happens, there will be a period of uncertainty. So all of this that I talk about is what's the impact of liquidity on the markets. I think the long-term fundamentals of the Indian economy remain strong, and it's only a matter of the liquidity ebb and flow, which may decide the market direction.
The next one, sir. Where will markets be 10 years from now?
I think 10 years from now, you will get, I think, double the returns of inflation, which over the long term in India has been roughly 7%. So at least you can expect 14%. That's what the past 15, 20 years experience also has been. So I think around broader market, it should deliver around the 14, 15% mark. And, specific categories and funds, the right choices can deliver even higher, up to 17, 18% over a decade.
The next one, sir. How do you see the earning prospects of mutual funds in general for the year 2022? What level do you expect the Sensex to reach by the end of December 2022?
I think the end of December, it will probably be about 5 to 10% higher than the current level. The reason being that the next 4 to 6 months are going to be very volatile and a range-bound market. And when direction clearly emerges at the end of this 4 to 6 months is when the new leg of rise will happen. So I think December 2022 is too short a time frame for the market to have gathered momentum and delivered that kind of a return. So expecting a single-digit growth in the Sensex up to December 2022.
The next one, sir. Can the cement sector give 15% CAGR returns in the next 10 years? Stocks just like Ultratech, Ambuja, etc.
I can't answer stock-specific questions, but the cement as a sector builds on the housing cycle and the infrastructure cycle, both of which have a good outlook from a 5-year perspective. However, the next 5 years after that, you could see cement capacities going into surplus, because all of this infrastructure demand means that cement capacities will be added strongly in the anticipation of growth. But cement is a cyclical sector, remember that? So in the next 5 years, you have to wait and see how it performs. So I would say 5 years is a good time to take a call. 10 years for a very cyclical sector like cement is hard to take a call. It could be at a down cycle, close to the bottom of a down cycle then. So I would suggest that you take a 5-year call initially, and towards the end of the 5th year, look at the situation and then take a next 5-year call then.
The next one, sir. With retail participation increasing in securities, Do you see the market depth growing manifold in India in the future?
Yes, I think that's the natural expectation. However, one has to still test out the resilience of the new age investor. Post the lockdown, you've seen a lot of demat accounts open and a lot of retail flows come from first time investors. They have not yet experienced a market correction. And corrections are a part of a bull run. Corrections are also inevitable in a longer term scenario. So whether these investors are mature enough to hang in there during corrections and stay invested is $1 billion question. If they demonstrate that resilience, then what you say is true, that the depth of the Indian market will tremendously improve.
The next one, sir. Why is the oil market not stable?
The oil market's stability comes from a counteractive forces. On the one hand, the US and it's wants to keep the price low. The US controls Iran to some extent, Iraq to some extent. Whereas Russia wants the price to be higher because their economy is dependent on oil. OPEC countries also want their price to be higher because their economies are also going through some trouble. They want to keep. So though US is pressuring Saudi Arabia to pump more oil, the new prince, his crown prince, is not yielding. So this check and balance between the two major blocks there, OPEC plus Russia and the US with Iran and Iraq, are the ones fighting it out there. And so there will always be a check and balance. On top of it, another balance which has come in is the Omicron crisis, with Europe getting affected. Then the demand for oil in the winter months, usually oil demand should pick up right now. But because of the fear of the thing and maybe there's a slowdown continuing in Europe, oil demand could be lower. So these are the factors that keep the oil prices in balance.
The next one, sir. Is Nifty in a bearish move or a bullish move? Will it correct and move to 20,000 in next April?
No, I don't think so. I think neither of them, it's neither in a bearish nor a bullish move. The valuations are looking a little on the higher side because the economic V-shaped recovery in the short term and the long term are getting forecasted. I don't see a threat to either of those, even with the new variant. What will, however, keep the rises in check is the fact that liquidity may drain out because of the new crisis. So I think that a range bound volatile Nifty, it's neither in a bearish trend nor a bullish trend in my perspective.
The next one, sir. Will the oil prices in USD and INR continue to will the oil prices and USD...
Can we avoid questions on areas that we've already answered? I just talked on oil in detail. Again,
yes,
let's not. You can just skip those questions because I think the answers would have been apparent. So don't go back to areas that we've already covered.
All right, sir.
Like I think you can drop oil related questions. You can drop Nifty outlook for short term related questions. All of those have answered already.
All right. The next one, sir. Now that markets have moved high and valuations are not cheap, is it good to invest in various equity funds?
Yes, I think this is the type of equity funds which you should choose. So there are two areas where I would say that you can look at even in this kind of a scenario, where the fund manager has the flexibility to alter the equity allocation, and two, where there is an option to straddle across multiple cap calls. So what I mean by this, I mean dynamic asset allocation funds like balance advantage funds or hybrid funds like equity savings funds are good because the equity debt allocation is not 100% equity or 100% debt. The second aspect, as I said, is the multi-cap and flexi-cap category, where even though one segment of the market may not perform, another segment could do well. So flexi-cap and multi-cap funds carry the advantage of almost always being present in all the cap curves of the market. So these two, I would say, depending on your risk appetite, the more aggressive investors can choose the flexi multi-cap route, the more conservative investors can choose the balance advantage. Even more conservative people can choose equity savings. So I think these two categories hold promise that even now mutual funds remain a good bet to park your surpluses for the medium term.
What about holding current investments, sir?
So I think that current investments, I would say that if you have not already done that, earmark significant investments to significant goals that you wish to achieve. So the stock market is never an end in itself. You're out there to make money to meet a certain need. And as they say, investment is essentially a postponement of consumption, right? So if you had wanted to spend the money, you would have spent it. You want to save it for a future spending. That future spending, you should have a clear-cut idea in your mind. And I would say, if you've not already done it, please take your portfolio, look at the major holdings, and identify them for certain specific goals. You may want to buy a Mercedes Benz, you may want to go on a Mediterranean cruise, whatever it could be, or you want to save for a daughter's wedding, whatever be the case, just it. And when that goal is kind of getting reached, ruthlessly liquidate your investments. So the stock market is only a means to achieve future spending goals whenever you be. Even retirement is a spending period. So I would suggest that the decision to exit from a stock market investment should be linked to non-stock market related investments. So if you want to buy
We seem to be facing a technical glitch. Please give us a minute. Welcome back, sir.
No, I'm back.
Yes, sir.
Yeah.
So, should we move to the next question?
Please, I finished my answer. I hope you heard the answer in full.
Yes, sir. Next one, sir. Why does SMF not have a floating rate category fund?
So we don't have a floating rate category fund because our debt funds, right, are yet to obtain the reasonable scale. We are building up the scale gradually. And when we build that scale is when we can launch a new floating rate fund. That being said, I would say that the liquid segment counts as a floating rate category. I'll explain why to you. Because we have all the segments of the liquid segment covered. And what happens in the liquid segment, because especially it's a money fund, is got a 30-day reinvestment cycle. The other liquid category funds have slightly longer cycles. The reinvestment cycle itself is a floating rate because you reinvest at higher and higher rates. Whereas with the typical floating rate fund, you buy bonds at fixed rates and you reinvest at fixed rates. So I would say that with other floating rate funds, you buy floating rate instruments, which may not necessarily reflect the rapid change in the interest rates. So I would say the liquid category represents a good alternative, and we would rather focus on that for the time being. We will evaluate the floating rate fund option in the future.
The next one, sir. Why are many AMCs launching NFOs now when the markets are at an all-time high? Is this not going to hurt investors 5 years from now?
The mere fact of an NFO is not going to hurt investors. Whether you stay invested in your current funds or invest in an NFO, you're going to be subject to the market. So investors in NFOs, if they don't invest in NFOs, will invest in any other open-ended fund. So all funds are subject to that market risk. So I would say the reason AMCs are launching NFOs is because SEBI had categorized AMC's existing funds into specific categories, and wherever there's a gap, an AMC would like to fulfill it, because if you have a full complement of funds, you can cater to various risk appetites of investors. And if you have a
So you were talking about catering to various risk appetites of investors?
I think various risk appetites and various market opportunities that arise from time to time. So I think that that's the reason these NFOs are being launched, because there are certain opportunities at this point in time, or they have a product gap in their portfolio. They're trying to fill that.
The next one, sir. How should one look at cryptocurrency as an investment space?
I think cryptocurrency, one thing is that it's a high risk, high reward bet. It's not something that very many people understand well. It's more on the speculative side. And so, as an investor, if your risk-taking mentality is on the higher side, even then I would suggest that yes, you should invest in the crypto class because your risk-taking capacity is higher, but limit that to, let's say, 10 or 20%. And within various cryptos, diversify across at least 4 or 5 cryptos, right? It's not a space where I'm an expert, so I cannot give you guidance. At the same time, it's very similar to gold in the sense that demand and supply for it drives the prices. And so it's an alternative to those asset classes. So be present there so that as you invest and you observe, you learn. And that's the best teacher for you. And over a period of time, you will gain experience in that. But that's not something that mutual fund experts like us are very experienced in. There's a whole new space there. So I would suggest dip your feet in that pool with taking the proper risk metrics in terms of how much you put their money in, how much you diversify, and experience the new age investment phenomenon that is there.
The next one, sir. What is your long-term view on PSU banks and internet-based companies?
So I think the PSUs. Yeah, I can you repeat the question?
Yes, sir. Your long-term view on PSU banks and internet-based companies.
So let me answer the PSU bank question. The PSU banks carry two great characteristics. One is that they have a phenomenal reach into rural India. Current account savings accounts called CASA balances. These are the positives for them, in addition to the government ownership, which gives a safety factor to them. But at the same time, if you look at it from a market, they're always valued at a discount to good quality private sector banks. The reasons for this are that one, that they are inefficient in their performance because the jobs are guaranteed and there is no pay for performance culture there. Number one. Number two is that since the government owns them, right, there's always a tendency to pay out high dividends back to the government and not reinvestment in the expansion of their business. So markets always on a price to book value, which is a way banks are generally valued, are at a discount to the private sector banks. Now, investing in PSU banks means that you will always be at a discount to a private sector good quality bank, but you can see that the level of discount can vary, and so you can make money from those investments. So you should apply the filter of good pedigree, right, good balance sheet net worth, and good risk management processes in these banks, number one. Number two, happening that their quality could improve over the medium term, strengthening already those strong points that I mentioned. Third aspect is the privatization. So as they get privatized and the government has already identified PSU as a sector which they'll allow as an, from a strategic, non-strategic sector perspective. So you will find that some of these banks could become private sector and go into the hands of private sector. So staying invested in that, again, don't expect it to be a multi-bagger. You can take that investment class to stay invested because ultimately they're government backed. And so you're unlikely to face the situation that they'll go belly up and so the equity will be down to zero in value. So the downside risk is protected. Upside risk is limited because they're always going to be at a discount. So only the difference in the rates of discount are going to lead to some wealth creation for you. So treat that as a part of your asset class innovation, and don't have unreasonable expectations from such an investment by looking at the difference in price to book and say, oh, that difference will come to me as a profit. No, unlikely to happen.
So what about internet-based companies?
So internet-based companies, they represent a great promise. They are being valued very highly. So what I would suggest is that my view to that is very similar to the view to crypto, in the sense that traditional stock market valuation methodologies do not work in assessing the price. So there is more of a technical analysis, more of gauging what investor interest is there, more of trying to read a blue sky future. So in that context, you could go very right or very wrong. So the answer is very similar to what I said. So take an exposure to that. limit the exposure to say 10% of your portfolio, diversify across the internet-based companies, because very often you find that a winner takes all. So in the food delivery business, there may be 3 or 4 companies fighting it out, but one winner will ultimately emerge. The same way with tech startups, anything. So I would say that you can't really predict who's going to be the winner. So if you diversify your risk, it's a quite high probability that the winner will be in your portfolio, and the loser will be in the companies will give it to you. So too simple, limit exposure, diversify across that segment is the answer I would give to internet-based companies.
The next one, sir. Would you be releasing a dividend for Sundaram Diversified Fund this month?
I can't reveal that information to you before it happens. It is our intention to book profits, and when those profits are realized, to declare a dividend. At this stage, whether we have already got the profits, no. So we are in the process, and we will have to then approach our trustees to declare the dividend. Subject to their approval, we will declare. But it's our intention to look at opportunities for profit booking so that we are in a position to declare the dividend, but that is not confirmed yet.
The next one, sir. I have an SIP in Sundaram Services Fund since inception. Which is the right time for bulk investment?
I would say that it's a multi-cap fund, right? So I would say that generally taking exposure to a multi-cap fund through SIP is an excellent thing, because in a multi-cap fund, sometimes small cap will perform, sometimes mid-cap. So there will be different leaders at time. And so when you give through SIP to the fund manager, he keeps reallocating the portfolio and delivering better returns to you. For you to take a lump sum view, as long as you take a view which is 5 years plus, anytime is good time to put a lump sum. But otherwise, see, SIP should generally be looked at based on the income which you are allocating to the mutual funds. If your regular salary income, rental income, or whatever is coming to you, then it's SIP. SIP cannot be a better investment tool than lump sum, except for certain strategic periods when the market is volatile. Right now, if the market is volatile, I would recommend SIP, STP as a route for the next 12 to 18 months. But otherwise, if you have lump sum, it doesn't make sense generally to stagger it and put it in. Lump sum, to put it in lump sum, always deliver better returns in the long run.
The next one, sir. Will India's wave 3 hurt markets soon?
Well, how do you know how bad wave 3 is going to be? Our vaccination rates are already 1 dose at 80%, 2 dose at 40%. Government is increasing the levels of vaccination by January, February, March. Latest, we should have 100% 1 dose vaccination, and maybe 50, 60% 2 dose. That will limit the impact of the third wave. Even this so-called Omicron, what we hear is that while it comes through and is very different from the earlier variants, it's not as severe. So unlikely to lead to another lockdown or a big economic impact. So I would say that markets will react to these because of the fears of liquidity being withdrawn, but not because of a third wave affecting India. So I don't think this market's reaction is India specific. It's about what happens if the world gets affected.
The next one, sir. I see SMF ads everywhere. Any new funds after the PMF deal in Feb or March?
Not likely, because February, March, January is when we will start the integration. You will give us 3 or 4 months to do the integration. So new funds will happen only in the new financial year.
The next one, sir. I am an investor in your Smart Nifty Equal 100 fund. Should I continue to hold it for my grandchildren for 15 years? Please suggest.
Enjoying the market with the Nifty fund. But the second is that the Smart Nifty, what it does, it keeps rebalancing. That means it cuts the weight of that which has run up and increases the weight in that which is not run up, which is fallen down. So over a longer period of time, you'll find this will give stability to return. So it's a very ideal choice because it's a low cost fund too. For a 15-year investment, I would say yes, it's a good choice.
The next one, sir. I have been investing in Sundaram mid-cap dividend reinvestments for the last 6 years. Is it good that I continue my SIP in this fund?
So actually, dividend reinvestment or growth doesn't make a difference. So please consult your advisor and see whether it makes sense to switch the SIP into the growth option as opposed to the dividend reinvestment option. I think effectively, dividend reinvestment means the dividend you receive gets taxed and post-tax gets reinvested, whereas growth option directly keeps growing. So please do consult your advisor on whether the SIP should be transferred to the Sundaram growth option of the mid-cap fund.
The next one, sir. I invest in Principal Equity Savings Fund as it is going to be merged with your AMC and it has become your entity. How do you maintain the same returns?
I think team from Principal to come over and they will be managing a portion of our funds. So I would say that since the CIO also, we are in the process, we have identified and made an offer and he's accepted, but he will join only after the thing. So I would say that the continuance of the principal equity team by and large will ensure that the fund performances are delivered in a very similar manner. I cannot assure you the returns, but definitely, the process and everything will be maintained.
The next one, sir. Did Sundaram Mutual invest in the Paytm IPO? If so, which funds?
I cannot disclose the stock specific information. My apologies.
The next one, sir. Is investment in gold better than mutual funds for 10 years for rupees 1 crore?
Absolutely not. Because gold is a function of demand and supply, which depends on three major factors. If there is hyperinflation, gold goes up. If there is a recession, and if the US dollar goes weak, gold goes up. So these are the three conditionalities which make gold go up from a demand supply perspective. So there's no guarantee that in 10 years' time, at the end of 10 years, you don't know what the situation is going to be. If the situation is one of hyperinflation or war or this, yes, that gold could have given you a better return. But you can't sit and predict that infinitely. So what happens is that equity markets are generally linked to economic growth and corporate profitability, which are always going to be better than inflation. So you're reasonably certain that over a longer term, like 10 years, you will get inflation beating returns from the equities as an asset class. So I would say that from that point of view, if you're going to keep your money away for 10 years, equities is a much better option than gold from that perspective. I'm not saying that gold might not deliver better return, but it's subject to those conditions then prevalent at that time. COVID like way thing comes up. But those are all very black swan events. You can't make an investment decision based on the occurrence of a very negative event when you need your money. So I would suggest that equities will always be the better investment asset class as compared to gold.
The next one, sir. How to invest in foreign investment funds and how do they work?
So foreign investment funds are essentially Indian mutual funds have got approved from SEBI to invest directly into foreign stocks or through the fund of fund route. So I think all mutual funds have foreign investment vehicles now. Sundaram has a Sundaram Global Brand application and everything is very similar to a domestic debt or equity fund. You simply have to go to our website and look up the fund or talk to your advisor and he'll advise you. How they work is they invest your money, take the money out of India, and based on the fund management expertise available outside India, generally like for us, Sundaram Singapore manages our fund, they will invest in the stocks that they choose based on certain parameters. Our fund, for example, choose the top 30 brands in the world as an investment vehicle. So to that extent, that growth of those brands will result in their stock prices growing and you will make a return. In addition, if the rupee weakens, that weakening of the rupee will also add to your returns. So I think you make returns from two perspectives, the growth of the portfolio as well as the devaluation of the rupee if it occurs. So that's how you make money from foreign investment vehicles. They are ideal investment vehicles to hedge against future foreign expenditure, like you may want to send your children abroad for education, you might want to do a foreign holiday, whatever be the case.
The next one, sir. What is the long-term view, say over the next 5 years for Sundaram Blue Chip Fund?
Sundaram Blue Chip Fund is, as you would have seen from the letters we've sent all this, is going to be renamed as a Sundaram Large Cap Fund, and hence it will mirror the large cap indices in terms of its performance and hopefully deliver a better return than that. So I would say that generally large caps deliver about 2 to 3% alpha over the nominal GDP growth of the country. So I think based on India's high single-digit growth rate expected and a low single-digit or medium single-digit inflation expected, you can expect over a longer term a reasonably double-digit kind of a return expectation from a large cap category.
The next one, sir. Why does the NAV of Sundaram Global Brand Fund not appreciate in the last 5 months? Should I switch to any other better fund?
No, the reason is nothing but the fact that international brand companies are well valued. And I think right now the world is looking at it, a consolidation phase and waiting for the growth paths to emerge. And the brands will take advantage of that. And second is that the rupee has not been very weakening related to other countries. It is, I think, among the stronger currencies in the world. So to that extent, the brand fund is probably in the short run not reflecting those two growth factors of a foreign fund that I just mentioned in my answer to a previous question. But over the medium term, both those factors should set themselves right. The world will come back on a growth path on a more broad-based basis, and these brands will be able to take advantage of that to enhance their growth prospects, as well as our longer-term view of the rupee is that it should be the rate at which the rupee should depreciate from a fundamental basis, and hence your returns should also reflect that kind of a movement.
The next one, sir. Are MFs better than FDs for a retired person?
What better?
Mutual funds better than fixed deposits?
Yes, I would say, especially if you are in the tax bracket, mutual fund returns. If you look at it, you stay invested for just 1 year. It's only a 10% taxation, whereas your marginal rate of taxation is 20, 30, or 40, depending on your income, will hurt your fixed deposit returns. That's number one. But the difference, please keep in mind that fixed deposit give you stable, assured returns, provided they are from a safe bank stroke company, whereas mutual fund returns are volatile. If you stay invested for the long term, you will end up benefiting.
The next one, sir. How are valuations of IPOs validated? Recent IPOs like Paytm were extremely overvalued but resulted in a meltdown. Can investors get visibility on the true value of such new offerings with third-party valuators?
No way. Because these are new age companies and nobody has a correct business model for valuing them. So there's a lot of hit and miss happening there. And so to that extent, I would say that mutual funds are a better route for you to access these IPOs because mutual fund managers will select and deselect certain IPOs, will buy them post IPO at a certain price based on their models. But as an investor, lay investor, it's very hard for you to assess the valuation of a new age IPO, like the names you mentioned. So I would suggest that if you do that, you just take a diversified bet on a mutual fund manager and that you will not get your foot all up front anyway.
The next one, sir. How to know which is long-term investment or which is short-term investment?
There's no such thing as a long-term investment or a short-term investment. It's your outlook to that. When do you need the money? If you need the money in the short term, you look at it as a short term. So generally, a short-term investment should be something which is less risky. So like hybrid funds, debt funds are more short-term investments. And the longer investments are generally more high risk because that high risk can lead to high reward with our accompanying volatility. So if in the short term there is volatility, in the longer term, that volatility will smoothen out and get you a higher return. So generally looking at the essentially the volatility of that investment. So any investments with a portion of debt in it has a reduced volatility compared to a pure equity investment. So that's the best way to judge short term versus long term. Your attitude towards when you need the money, and second, the amount of volatility that is inherent in the stocks in or investments in that portfolio.
The next one, sir. For the long term, which funds can give more returns for 10 to 20 years?
So I would suggest that you can look at the flexi cap, multi cap category as well as the mid cap category because I think in the long run It's India's domestic economy which is going to drive the returns, and mid and small cap stocks generally are well oriented towards the economic growth translating into their earnings. And so, if you are willing to stay in this for the long term, right, a high risk investor could choose a mid cap thing because the volatility will also be higher. But a flexi cap or a multi cap gives you an exposure to all three segments of the market, and hence will reduce the risk without giving up as much of the reward. So, they are a better bet from a more moderate risk oriented person.
The next one, sir. What is the effect of increase in the price of raw materials and inflation, and on how many quarters will these effects last?
Well, how long the raw material prices increase is going to last is anybody's guess. So commodities, which are essentially the raw material inputs, are generally linked to a global cyclical wave. And what happens is that the US, for example, has passed a $1 trillion bill, which is Joe Biden to sign off, right? And if the advanced economies come back on a growth path and infrastructure spending rises, commodity prices will rise. And so that effect can be there for multiple quarters. But remember, it's not just the price rise of raw materials, which is inflation or raw materials. The ability to pass it on to the ultimate consumer will help protect corporate profitability. So if demand is strong, then price rises can easily be passed on to the ultimate buyer. So I think that it's a combination of the two. So the raw material price rise, inflation, if they are combined with the economy in a revival mode, it won't affect corporate profitability.
We'll take one more, sir. Will the increase in US rates hurt Indian markets over a 3 to 5 year period? Should we expect flattish returns over the next decade from Indian equities?
Not necessarily. An increase in the US interest rates reflects that US inflation is rising. That's why interest rates are rising. And the reason inflation is rising because in the US demand is exceeding supply, which means that if demand is exceeding supply, it means that the GDP growth is very strong. So if the US GDP growth is very strong, Indian companies will prefer manufacturing outside of US because they don't have the cheap labor or the commodities to satisfy their demand. So, a commodity exporting countries and labor exporting countries and manufacturing exporting countries will benefit from that scenario. And India is ideally situated as a labor surplus country, which is now getting its manufacturing act in order with the PLI scheme and the ease of doing business, improving and low corporate taxes. So manufacturing is set to triple in size as a percentage of GDP over the next decade. And this is going to be largely on the back of exports to advanced economies like the US. So a rising US interest rate will lead to a strong economic growth both in the US and India, and hence Indian stock markets will react to the strong economic growth, and corporate earnings will rise and give you very good returns. So as opposed to the fact that this rising interest rates will lead to a tapering of the liquidity. So the balance is that the liquidity will taper, but the earnings will go up. But I expect that domestic liquidity will also go up, and hence any external liquidity going away will be more than countered by the better earnings, by domestic liquidity, and the fact that long-term money from the US also, like pension funds, doesn't get affected by the interest rate scenario. They are looking only at the growth from the underlying economies from which they need to get the returns to pay out the pensions for their subscribers. So I would say, argue that in the short run, rising US interest rate scenario may be negative for the markets, but in the long run, it's good for the economy, hence good for the markets also.
Thank you, sir, for taking out the time to answer these questions. It's been quite an insightful session.
Thank you, all of you. Stay safe, and my apologies. The internet connection glitches meant that there's been a bit of a stop-start to the session today, but otherwise it was an enjoyable session. Thank you very much. Look forward to the question hour in the next month.
Thank you, sir.